Folks, I want to talk about one of my favorite market barometers, the volatility index. Normally, I use it to quickly gauge market sentiment. You see, elevated VIX levels means there's fear in the markets. The opposite is also true. Low levels below 13 usually signal investors are complacent. But what is the VIX actually measuring? Well, technically speaking, the index tracks the 30-day volatility of the S&P 500 options. So when it rises, it means the market expects more volatility, bigger swings in the price of the stock, which increases the price of the option. VIX is up quite a bit in the past 2 weeks, but it's not necessarily a bad thing, especially if you're familiar with one of my favorite strategies. All right, folks, this is the volatility index, and I know I tried to explain it, but it's much better when we're looking at it together visually. So, now, you might have heard the term implied volatility when it comes to options, or maybe not, but implied volatility is the expected price in the future. That's priced into the asset right now. Whenever you're trading an option, the option always prices in future value ahead of time, anything that's known. So if something is fearful expected to happen, the implied volatility will blow up. If something benign is expected to happen, or if the markets are expected to be complacent, like it's a holiday week, volatility will typically decline because there's less price movement expected. So hopefully that explains it. The VIX index is the implied volatility barometer for the entire S&P 500. In other words, if you're looking at individual stocks, you will have to look at the implied volatility for that stock. But if you're looking at the overall S&P 500, this chart is the implied volatility as it's expressed, because what it does is it measures the volatility of the at-the-money options. So if the S&P is moving lower and traders are scared and they're nervous, the VIX will represent itself by jumping up to 20. That represents a fear level in the VIX. If the fear level is benign and there's very little happening in the market, the VIX level will come back down. So for example, last year when we had the little meltdown in the Dow Jones during the holiday season of 2018, what we saw is VIX spiking up to 35. That's telling us traders were scared. We can even go further back here, and you'll see here, this is around Brexit. So anytime you see a level of fear in the market, and I'll give you a clue, it usually happens when stocks go down, when markets are going down, the VIX will spike, all right? Conversely, anytime there's nothing happening in the market, the VIX will move down. So if you want to get a quick look out to see if markets are appraising anything of fear, any level of fear, all you have to do is look at the VIX and you'll know exactly what traders are thinking in terms of fear versus greed. So the next question, now I kind of gave you a good little understanding of the VIX index. And VIX has been lately kind of low because there hasn't been much bad things going on. And even if there were bad things going on, like China and US, the trade war, low interest rates kept everything stable and kept the stock market near 52-week highs. So volatility has been lower historically over the last year than its usual value. That means options have been historically underpriced. But here's the thing. We got elections this year. All right. We got this thing with Iran that isn't really fully resolved. We have more. This trade war is just getting started. We're only in phase 1. We've got the coronavirus that doesn't seem to have an end in sight. And there's earnings that are still on the table. And this year, we're expected to have more volatility in earnings, which means the markets are expected to be more volatile. Furthermore, the Fed is expected to start withdrawing quantitative easing as early as April. That means they're going to take the training wheels off the bike, folks, and they're going to let the market do its own thing. That's going to increase volatility. Quantitative easing, Fed buying bonds, keeping interest rates low, is an amazing factor of stability for the market, which has been causing an indefinite bull market lasting 10 years. But with that said, as volatility moves higher, as the VIX level moves higher, what you're going to see here is higher value in option premium. And when the value is higher in the premium of the option, if the S&P VIX rises, that means all the stocks in the S&P and all the other stocks in the markets are going to rise too, because this is not isolated. Usually when you have fear in the market, it extends itself all the way through large caps, medium caps, small caps, blue chip stocks. The market does not discriminate when it comes to fear or greed. So the paramount point is, let's say you're a premium, you're an income trader, and you're looking to take income from the market. Well, instead of taking $1.50 for example, $1.50 for 50 cents risk, you're going to be able to take $2, $2.50, $3 for 50 cent risk. In other words, your risk will be smaller for the premium that you take in, because the premium is going to expand. It's going to inflate. And I'm going to tell you something. Don't underestimate implied volatility or the VIX level. For example, I've seen options that sell for $2, sell for $6, $8 when implied volatility rises. So I'm not talking about like taking 20 cents or 5% more premium. I'm talking about real cash here. I'm talking about real money. I'm talking about instead of taking $1, taking $2. Instead of taking $2, it's taking $4. I'm talking about a real premium. So when volatility rises, when the VIX level rises, it creates better opportunities or more opportunities or juicier opportunities for income traders. And that's what you can expect in 2020. Now, we're just in February. The year's just begun. I'm going to tell you something. One of my predictions for 2020, and I'm not wrong that often, has been volatility moving rising, and that's what I'm seeing ahead. So I hope this gave you a good understanding of what the VIX index is and how to use it effectively in 2020. Want to take advantage of elevated VIX levels? Then you need to check out a new strategy that a fellow trader, Rob Booker, has recently been using. It exploits volatility to generate a high and consistent income stream. In fact, you decide when you receive income and even how much. It's possible to create a second income stream of a few hundred or even a few $1,000s a week. Get all the details here. Follow the link below.